A very good evening to you all, friends. I, Sanjeev Singhal, Chairman of the Auditing and Assurance Standard Board of ICI, welcome you to the second webinar of the AASB for this council year on quality control for audit of financial statements and materiality in planning and performance of audit. Friends, as we all know that audits are
Recording
going on.
in progress.
The busy audit season has started, and we thought it appropriate that we conduct these webinars on the virtual mode for our members, covering the various aspects of the auditing standards. And the reason for conducting them on virtual mode right now is that we understand that most of you will be on the audits. So that's why we are doing it on the virtual mode. And with each webinar, we are covering separate topics. The topic for today is very important: quality control for audit of financial statement and materiality in planning and performance of audit. As you know that there is a lot of talk around audit quality, and audit quality has always been of paramount importance to us at the Institute of Chartered Accountant of India and to you as members of the Institute of Chartered Accountant of India. It is very essential that whatever we do, whatever procedure we perform during the course of audit, quality is the most important parameter. Now, there are certain quality controls that are to be exercised across the firm level, and then a few quality controls which needs to be ensured while you perform each audit. And similarly, when we talk about materiality, because you have to give a reasonable assurance. So obviously, we are not giving a complete assurance. We can look at only the material aspect. For example, if the revenue of a company is 10 crore rupees, and there's another company whose revenue is 1 lakh crore rupees, we cannot perform same procedure to the transactions of the same amount. We'll have to keep that materiality into mind. It could be a performance materiality or overall materiality, and a tolerable error, and a SAT, which is a summary of audit differences. And then an auditor looks for what is the number of transactions, what is the amount of transactions which he needs to audit. So these two aspects will be covered by two of our experts, CA Vishal Sharma and CA Praveen Kumar, both of whom are very experienced. And this session, the keynote speaker is CA Pramod Jain, a good friend of mine, Central Council member from the Northern region, and chairman of the Accounting Standard Board. And we also happen to be from the same college. So Pramod Bhai is a commerce graduate from the Shri Ram College of Commerce. He, besides being a member of ICI, is also a member of the Institute of Company Secretaries of India, as well as the Cost Accounting Institute. He's also a law graduate and qualified information system auditor. He's also a member of All India Management Association and an insolvency profession. Probably Pramod Bhai, you have not left any qualification, which is yet to be acquired by you. He's also passed the certificate course on CSR of ICI and the proficiency test for independent directors. He has passed certification course on NCFM of National Stock Exchange and certification course on CAT and post-qualification certificate course on valuation of ICI. So as I said, currently is the chairman of Accounting Standard Board and is also chairman of the Expert Advisory Committee. He's delivered more than 1,400 lectures, rather maybe more. He's also a member of the QRB and is a senior partner of Messrs. Lunawat & Company. So thank you, Pramod Bhai, for joining. I know that your profile is large enough, and to do the complete justice with the profile, probably I need at least 10-15 more minutes. So already 1,300 plus members have joined, and I wanted to thank you. And let me also introduce two of our speakers before handing it over to Pramod Bhai. CA Vishal Sharma, the member of ICI and has more than 25 years of experience providing auditing and assurance service to Indian multinational companies across various industry segments. His experience includes working on the US GAAP and IFRS assignment, handling IPO and other capital market engagements. He has also led the audit quality reviews and related matters for the firm for many years. Prolific speaker, he has been a speaker on many occasions with ICI and is a partner with SR Bartley Boyd. Another speaker is CA Praveen Kumar. CA Praveen Kumar is a partner with ASA and Associate, is also a national head of assurance division of ASA. He has over 30 years of post-qualification experience. He's been a member of NACAS as a special invitee, a member of ASB, and presently is a member of AASB with me. He is an experience on large number of assignments. He's been speaking at the national, at the international level. And of course, his personal hobby includes marathon running. So he's a model that way for many of us, keeps himself fit. So thank you, Praveenji, for sparing your time. So friends, from the Auditing Standard Board and from the whole issue, it's our sincere request that please exercise professional judgment and care. Be vigilant while during the audit. It's the quality that should speak for itself, and it's the audit quality that will be a brand ambassador for our profession. So please do your best while discharging the attest function. And with this, I would request my council colleague, C. Pramod Jain, to give his keynote address. Over to you, Pramod Bhai.
Thank you very much, Sanjeev Bhai. Namaste to all. CA Sanjeev Kumar Singhal ji, a very dear friend and a Central Council member with the same terms, who's the chairman of the Auditing and Assurance Board of India, and as well as chairman of a very important board which has caught awares of not only the Indian regulators but overseas regulators also. The Sustainability Reporting Standards Board, and which has come out with one of the first standards on the sustainability reporting, which has really caught eye of various regulators throughout the world. And even for the social stock exchange, Sanjeev Bhai is working very hard, and to do his efforts, the SEBI has given the whole project to the ICI to establish the standards and all those things. Sanjeev Bhai, thanks a lot for keeping the flag high of ICI at all the times with all the regulators. Thank you, and really the way you are doing generating, in fact, I would say sharing the knowledge, educating members to keep themselves aware of all the latest, wherever you have, whichever committee, whichever board you have taken in the last 3 years as well as this current year you have started. So that is really remarkable. I really adore that. Really great.
Thank you.
So in that series today, a very apt topic kept, and that is relating to the quality control and the materiality planning. And for that, we have two speakers, very eminent speakers, Vishal Sharma ji and Praveen Kumar ji, again a very dear friend. Both have been contributing to a great extent to ICI over several years. And when you will be hearing them, of course, you will be, you must have heard them earlier too. But on these topics, again, when you will be hearing them, your various concepts will be clear. Friends, sometimes what happens that we feel that audit, why there is a need to study audit, तो हमारे खून में पढ़ने की क्या जरूरत? But it is not that way, friends. You know, a person, a professional can do anything. But maybe GST, income tax, accounting, direct tax, indirect tax, whatever it may be. But auditing is the monopoly of ICI. Let us just understand this. Auditing of a financial statement can be done only by a chartered accountant in practice, and we are having this monopoly, and we'll be able to retain this monopoly only if we are able to have the quality of that, enhance, not only maintain but enhance that quality. All the stakeholders should feel that when a financial statement is audited, it bears the report, the verification, the opinion of the auditors. It is free from all material misstatements, I would say. So that faith has to be created by all of us. Whether we are doing an audit of a listed company or an unlisted company or a public company or a private company, or even I would say even a partnership, proprietorship, LLP, whatever audit, let us not forget that audit is not only of the companies, even of the non-companies. We might have a thought process that in the tax audit there is no audit of a financial statement. Some of our friends, because we have been talking this at several places throughout the country, that in tax audit, what is there? Form 3CD, 44 clauses. No, it is not merely that. In case of proprietorship, partnerships, and other entities which are not audited under any other law, you have to audit the financial statements within that framework of the Income Tax Act itself. So when we talk about maintaining the audit of the quality of the audit, we'll have to do in the case of even tax audits. So even a a colleague of us who is sitting at a remote place, when he is doing an audit of a financial statement through the tax audit, he have to maintain that quality. Quality of the firm as well as quality of that as engagement per se. So we all need to have proper personal management and ensure that there is an independence, integrity, and objectivity in whatever audit you do. Have that engagement properly, have proper documentation, of course, and then monitoring to ensure that we have an adequate quality control over that audit engagement. Firm as well as the audit engagement both. So quality is very, very important and we need to improve. And my both friends would be talking about the relevant subjects, whomsoever it has been assigned to. Another very, very important thing which the topic which we will be discussing today is the materiality planning. Now, materiality in, I would say, our members who are not auditing the listed entities or the bigger companies or the India's companies, high net worth companies, materiality concept is a very, very important concept, which is not restricted merely to the quantity, but even to the quality. So both the quality and quantity of the misstatements are relevant to decide what is material and what is not material. Because the basic objective of a financial statement audit is to actually enable that auditor when he expresses an opinion that whether these financial statements are prepared in all material aspects in accordance with the applicable financial reporting frameworks or not. So why materiality is there, how to calculate it, and where to use it. So that materiality concept is very, very important. We say sometimes in say tax audit, say 3CD, the materiality may not be that much important. But again, when we say reporting for the financial statements, even in the tax audit, that materiality concept is there. Is there. So we need to have that materiality planning and do our audit according to that. So my friends, I'm hoping to have a great session, great learning session. My best wishes to all of you for having a great learning session for today's webinar organized by the AASP. Thank you very much, Sanjeev, for giving me an opportunity to share my very initial views. Thank you very much.
Thank you very much, Pramod Bhai, for giving an overview of the subject in such a short time. And your passion for knowledge of all the subjects is known to all the council colleagues and the members in general. So thank you so much. Friends, with this, now I would request both my learned speakers, starting with CA Praveen Kumarji, to kindly start the deliberation on this topic. Over to you, Praveen.
Thank you so much. Thank you, Sanjeev ji. Thank you, Pramod ji. It is, I'm so glad to be on the same platform with both of my close friends. And it's the topic which has been given to me is very, very important, like Pramod bhai said. And
Praveen ji, I'll just interrupt. Sorry, my vice chairman, very able council colleague, Vishal bhai has also joined. So Vishal bhai, welcome. I know that that you were in another meeting, so thanks for joining. And looking forward to your inputs as well at the relevant stage. Vishal bhai, would you like to speak anything right now, or do we keep?
No, we can carry on. We can carry on, sir.
Thank you. So sorry, Praveen ji. Sorry for interrupting. Please go ahead.
So thank you so much. May I request the technical support to allow me screen sharing rights?
Yeah, IT team, I have requested you to allow all the panelists all the time. So please make Praveen Kumarji as co-host.
Okay, so thank you so much. So the topic which has been given to me is quality control for audit of financial statements. And in the whole, this presentation is around 35 slides. And I hope I will have around 40 minutes or so. So that I can talk about the quality control in audit of financial statements. So I will try to make this session a little practical one. I'll begin with the framework which IAASB has issued, the contents of framework of quality control on audits. I will then move on to the practical side. There are reports which have been issued by the regulators. I'll pick up an example and a case study from there. And then I will go to the audits. When you're doing the audit on the field, then what kind of work papers, what kind of areas you can look into, and how you can prepare your work papers so that in case tomorrow there is a question, you should be able to answer the question that how the audit was carried out. So with the help of case study and with the help of experience, I will be sharing these slides. As always, there is a disclaimer. Whatever I am going to share is my own personal opinion, and it's not opinion or thoughts of the institute or AASB or ASB. So I'm sharing my own experience, and thoughts which I'm going to share are my own thoughts. So IAASB brought out the framework which was for audit quality, which described the input, process, and output factors that can contribute to the audit quality of the engagement. And it can be the firm level, and it can be at the national level also for financial audits. So the IAASB, it mentioned that the term quality is it's very frequently used term, and it's debated amongst various stakeholders and regulators, standard setters, audit firms. Everybody use the word audit quality, but there is no definition or analysis, where the quality can be measured in, it becomes very complex to measure the quality, the audit quality. It's very, very difficult. It's very, very subjective. But the framework provided key elements of audit quality. These elements for input, what is being picked up, how that information is getting processed, and what kind of output is coming. And then in order to have this framework, there was a key interaction with the supply chain of the financial reporting people. And then contextual factors were also discussed in this framework. I'll spare a minute and discuss with you these contextual framework where, when you're doing an audit. So one is a financial reporting framework, which you are concerned with. You also have to look at the corporate governance of the organization. Like Pramod Bhai said that many times you are doing, you are carrying out audit of a small entity or maybe tax audit. That time also you will need to see the kind of people who are running the organization. And if the accounts and the information is coming out of information system, IT, then you have to be worried about that as well. Then there are cultural factors also which play an important role. And the timetable, what kind of time is allowed, when you are doing the audit. These are all areas where your audit quality gets impacted. Your input, your processing, your output is getting impacted. Then what kind of talent you have, what kind of people you have deputed to carry out those audits, and how you are retaining and how you are attracting them. Then litigation environment, what kind of environment the company or your client is working in, what kind of audit regulations you are working in, the business practices and the commercial law. So these were all factors and law and regulations related to financial reporting. They were all factors which were impacting the audit quality. But primarily, broadly speaking, the factors which can affect your audit quality, these are mentioned here. The person who is doing the audit, what kind of knowledge and what kind of skill set that person is carrying. Whether that person, while doing the audit, is using professional skepticism also, that impacts the audit quality. So to give you an example, if you are working in a very tightly controlled environment, there is a chance that a professional, while carrying out the audit, become little easy, and the assumption is that there should not be anything wrong in this financial reporting. But it is important for that auditor to have skepticism all the time. Standards and their compliances, what kind of standards are there in the jurisdiction in which you are carrying out the audit. Working conditions, where you are working, and how the information is getting reaching out to you. So to share an example, we were attending a review which was being carried out by a regulator, and the question which was asked that where from this information has come. So our audit team mentioned that this has come from the ERP system of the client. The next question the regulator asked, that whether your team yourself, team member only extracted the information, or it was extracted by the client and was given to your team member. So when they said that the client only digged out the information, so the next question was whether your team member was sitting there when they were extracting the information. So the point which I am trying to convey is that what kind of working condition and what kind of skepticism you are using when you are carrying out the audit. Audit duration and quality control, these are all factors which are directly affecting your audit quality. If you go back to the cases where the financial reporting was under question and reporting frauds had taken place, so it was very clear that the auditors, they relied on the information which was given to them by the management, and because the professional skepticism was missing, so they were found guilty of professional misconduct. So the purpose of audit, like Pramod Bhai also mentioned in the beginning, it is to validate the confidence of the users of these financial statements. Audit shows whether, so this is basically the purpose of the audit is that where you stand and, where you help information getting onto and how you go to the next steps. So the audit core and enduring mandate is to attest that financial statement give a true and fair view in all material respects. So we will be having a discussion on materiality as well in the coming session. And so this is what the purpose of the audit, basically to enable all the users to get that confidence that financial statements are giving true and fair view in all material respects. And it is very important for all of us to be aware of it and to spread the word around that the purpose of audit is to give that confidence or attest that financial statements give a true and fair view in all material respects. So we are not giving a true and correct view on the financial statements. We are giving a true and fair view. And what is quality of the audit? Basically, whatever judgment you are making, whatever opinion you are giving, quality means a total commitment to making the sound judgment. It means that all right steps were taken consistently in the course of an audit so that you can reach to the opinion whichever you are writing. Now, when you are carrying out the audit and you are applying the SQC1 and standards are there, So basically, you have to demonstrate in the future that your audit documentation, which is also known as work paper, basically you have to demonstrate that you carried out the audit procedures, you obtained the evidences which were required, and you have reached to the conclusion how you have reached to that opinion. So there were common observations which were, observed by the people who were doing peer reviews and the people who are from FRRB, that many of the audit files, they included evidence sought during the audit, but documentation of audit procedures, planned, performed, they were not robust. So whenever, people when they are sending their teams to carry out the audit, it is normally observed. And when we are talking about in practical terms, when we are doing audit of a small or medium enterprise, and we are a small and medium practitioner, we believe that if we get a confidence that the numbers which are mentioned in balance sheet and profit and loss account and the financial statements, if these numbers are okay, I can sign off and give my opinion. But actually, this is not about your getting confidence, my friends. It is about getting your papers in place, in file, that you have obtained the evidence that the numbers which have been mentioned therein are true and fair. So basically, documenting what have you done. When let us take a very, very simple example. If your team is going and doing audit of a small entity, and they are doing review of depreciation. What they do is they obtain invoices which are for the assets which were purchased during the financial year. But what have you done with those invoices? That has not been written on anywhere. So maybe a piece of paper on top of it, or maybe on the copy of the invoices itself, you have to write down what have you done with those invoices. What have you checked? Whether you checked that the name is in, the name on the invoices of the company, whether the date is in order, whether the item which was purchased was actually the asset. So I remember when we used to do articleship, we were told by our seniors to use ticking of a particular kind with this particular color, and we should do the ticking at both the places, at the invoice also and at the ledger also, because that time there were all manual ledgers used to be there. But now a lot of information is there on your computer screen. So you need to prepare a work paper which will demonstrate what have you done with those invoices. How have you got the comfort that the depreciation which has been claimed by the organization is according to the policy which they have disclosed, and it is according to the limits which have been mentioned in the regulations, in the law, and the accounting has been done in the manner which has been allowed by the accounting standards. So you need to document the audit procedures which were carried out. So this part of the audit documentation is the most critical part, in our audits nowadays. So audit documentation should provide that evidence. Your audit file should carry those papers, but what is the basis for your report and your conclusion, and audit was conducted as per the auditing standards and regulatory requirements. So in the current scenario, when there were reports which started coming out after the NAFRA has come into play, and after those scams which have come into play, the audit documentation, audit work papers had gained a lot of importance, because those are the papers which have been seen by the regulators, and comments have been passed based on the documents which are there in the file. So you don't need to sit in front of the the person who is doing the review to explain what have you done. Your file, audit file, should be speaking by itself. So the point which I'm trying to convey to you is about your work paper. So whichever document you collect from the client, you have to use this PCENT form. So that means you need to mention the purpose. What is objective? How, what is the purpose of these audit procedure? Why have you picked up this paper and what are you doing? Why you are doing? Then source of the evidence. Who provided by this information? Now, earlier the confirmations used to be collected by the client and was used to be provided to the auditor. But when you look at the auditing standard carefully, it says that third-party confirmation has to be directly obtained by the auditor. So who provided you this document? What is the source of this confirmation? You have to mention it there. And then conclusion. And this is one point which is, according to FRRB, is one of the key point which we all need to be very careful about. That conclusion should be documented, and whatever audit procedure you perform, what happened after that? Did you arrive at a position that this number is fine, this number is not fine, whether you found any reconciliation items in those? Then extent, what kind of sampling methodology was used, how you picked up the samples, and what kind of samples you have picked up, what is the basis? That has to be mentioned in your audit work paper. Then nature, the kind of documentation, the kind of audit procedures you perform, what is the nature of the, whether you did cutoff testing, whether you did completeness, what all have you done in order to reach to that conclusion? And what is the period of the evidence which you have verified? So basically, when we talk about the regulator, after NAFRA has come into play, there has been a lot of discussion around audit work papers and the audit quality. So as you are aware that Rule 8 provides power to NAFRA to review the working papers and communication related to audit. Then NAFRA is also empowered to evaluate the efficiency of audit control system and the manner of documentation, and then perform such testing. That is also power which has been given under Rule 8 to NAFRA, that they can do such testing of audit, supervisory and quality control procedures of the auditor as may be considered necessary or appropriate. So I'll take an example which will tell you that when we are carrying out the audit, we need to be very careful about the quality of the audit which we are doing. So when NAFRA did review, and this report which is available on the site of NAFRA, so there are some extracts which I wanted to share it with all of you. It will give you an idea that what kind of things which you should not be missing out on. So one of the point was that 11 instances of mismatches between the work papers, which is in the soft copy and in the hard file. So when NAFRA was looking into the work papers, so there was a hard file which was provided, and they were also looking at the soft file on the computers of the people who were doing the audit. They found a mismatch. The hard file was saying something else, the soft file was saying something else. Lack of evidence of analysis which was carried out by the audit firm, and evidence were not attached. Whatever management assumption was management assumption regarding going concern. So the audit team could not gather and connect the accompanying evidence for going concern. Then work papers did not include discussion on fraud risk. So this is what is coming out of, these are extract from the NAFRA report only. And I'll be giving you the link also in case you want to have a, to read these comments of NAFRA. Then audit strategy memorandum contains staggering conclusion not supported by evidence of substantive work. So ideally, when you are carrying out the audit, you need to identify the risk. What are the risk areas? On the basis of those risk areas, you need to define your audit strategy. And on the basis of that strategy, you will be carrying out your audit planning and then your field work. And then you will be reaching out to the conclusion. It all has to be under the same thread. And work papers, when engagement partner is giving instructions to the team, the work papers or the minute of those meetings they should clearly demonstrate the discussion which had happened and what are the areas which were explained by the audit partner. So the work paper, which was management representation note, and many times, when you take MRL, you become little easy on, okay, it is MRL only. But when the regulator looked at that paper, it was not addressed to the auditors or it was not dated. So it was a very serious comment that this kind of management representation is not acceptable. So what I am trying to convey to you is the practical aspect. So then when you are taking a management representation, please ensure that representation is dated, it is addressed to you as auditors, and it is signed by the appropriate person, which is from your client side. Then in one of the comments, it said the reversal of ECL, expected credit loss, was not supported by any evidence in the audit file. So this was a comment when they looked into the audit file, they realized that one of the reversal, there was no evidence in the file. How did the auditor draw conclusion? Then in loans also there were comments, and in one of the agreement which was there in the audit file, it was not signed by all people and it did not contain the name of the signatories. These are small little things which people generally miss out on when they are carrying out the audit, or they say that, okay, let me collect this paper and later on I'll get the signed copy. But once these papers are filed and then you move on to the next audit. So your audit quality, that quality is compromised. So in case the sign agreement would have had some other clauses, you would be missing out on those aspects. So, this source of this report, it is there. The screen in front of you is showing the link. So you can go to NAFRA site, nafra.gov.in, and then you can look into that report. Now, when you are carrying out the audit and you are ensuring that the audit quality is properly maintained, what kind of audit file you should be having? You should ensure that these areas like appointment formalities, then audit planning, then execution and other procedures, and completion and reporting, all files are there, properly maintained, and which will demonstrate that you have carried out your audit as required by the auditing standards, and you have not compromised on the quality of audit, which was expected to be done. So I'll go to each of these items, and I will be sharing some of the critical, extract from key areas which you should be very, very careful about in order to ensure that your quality of audit is maintained. When you are doing the appointment formalities, please look into the risk management because this is requirement of standards on quality control. You need to have a client background check or KYC, know your client, and then acceptance decision checklist should be there. Engagement risk categorization, that what kind of risk and which are the risk areas where you need to be more careful about, because your audit strategy and audit planning will be dependent on these risk areas. Independence confirmation from partners. It is very critical to have the signed independence confirmation. Now, what happens when you're, only you are having 2 partners or 3 partners? You ask from each other whether this client is related to any, or whether your partners are independent. You say, yeah, we are independent, but that will not be sufficient. It is important for your audit file to have that signed independence confirmation from the partners and the engagement team. And as required, if you are doing audit of a company, then there are certain there are certain requirements which you need to have in your audit work paper file. timing and dating of these documents are very, very critical. You need to communicate with the previous auditor before starting of the audit or before taking up the assignment. You need to have audit acceptance communication, and you need to have a signed engagement letter. All these papers, it is very important for you to have in your file before taking. So these are all appointment related formalities which you need to carry out. And you need to have a documentation demonstrating that you have completed all those appointment formalities. Then when you are doing audit planning, then your audit planning memorandum, which will include what is the scope of the audit, what is the client business, the kind of industry the client is working in case they are banking and finance related industry, what are the guidelines of the Reserve Bank of India, what is your audit team composition, who are going to do the audits, what are their experience, and whether you need a domain expert in that area or not. What kind of planning you have carried out, you need to minute that. I know it is sometimes it is felt that there is no need to keep document for everything, but trust me, whether you are doing audit of a listed company or you are doing a tax audit, it is very critical to have your planning meeting and documenting those planning meeting. Client kickoff meeting has to be planned and the document has to be kept in your file. Then your analytics between the current and previous year, that has to be done at the planning level itself. And also we will be hearing about materiality determination. That document should be there in your planning file itself. And your audit strategy, that which are the areas which you are, after identifying your significant risk, then your strategy should be moving, what kind of actions you are planning to take. Then your risk identification, audit strategy, audit planning, and the fieldwork and the conclusion, it all has to be documented. And you need to budget your man hours at the stage of planning itself. While doing the execution, you need to ensure that your audit plan, audit program, your lead sheets, lead memo, and control testing, all these areas, whether it is revenue, whether it is inventory, investments, trade payables, or cash and bank, you have to ensure that whatever work you are carrying out in your execution of audit, you need to document whatever purpose, the peasant form which I have mentioned, whatever document you are collecting, what is the objective and how you are going to carry out the audit. There are other procedures which you should be careful about. And nowadays, a lot of stress is on related party transactions. And especially when you're looking at smaller entities, you need to be extremely careful because a lot of related party transactions might be there. And in case of listed company, there are regulations around given by SEBI and the Companies Act. So you are in any case going to follow those, to understand, to review those. Then IT testing, when you are working in a complex IT environment, or let us say ERP environment, you need to ensure somebody who is expert in IT is looking into the ITGC and looking into the computers and the softwares, how the information is coming out. To share an example with you, we were doing audit of a large insurance company. And when my team went there, the insurance company people, they were very happy to receive the audit team, and they said that we don't do anything here. Everything comes out of the computer and you have to just sign off. But the team went into detailing at how the software is providing that information. So do not assume that wherever there is an ERP, the controls are tight. It is there is a possibility of lacuna in the controls in ERP environment as well. So basically auditing the estimates, whether it is expected credit loss or whether it is useful life of assets, you need to understand what estimates the management is using, and especially employee benefits. So a lot of estimates, they are given to the actuary on the basis of which they bring out the provisions required. So to share another example with you, we were doing audit, and the management said that the whatever amount is coming out of actuary certificates, you just look at that. But when we looked at the assumptions which were taken by the actuary, those were very, it was not appropriate. So they had taken very small number as, the annual increment estimated. So when we questioned it, so they agreed that this point was missed out, and they asked actually to do the estimation again. So when you look at litigations, when you look at reports of internal audits, when you look at secretarial documentation, you come to know a lot of things which might impact the true and fairness of the financial statements. Some points on which you need to be extra careful in present environment. While standard on auditing 570 give you guidance about the going concern, you need to ensure that at planning stage, at execution stage, at reporting stage, you need to have your documentation in order, and you need to also communicate with those charged with governance about what kind of procedures you are planning to carry out. Then another point which I have observed, that many times people pick up and request the client to share the minutes of the board meetings, and they keep those board meetings minutes in their file, saying that, okay, we have collected that as well. But what have you done with those minutes? So merely putting up copies of the meeting minutes is not audit. You have to ensure that whatever decisions were taken in the board meetings, whether those decisions are affecting your financial statements and whether they have an impact on your audit procedures. Then litigations, standard on auditing 501 gives you guidance, and you need to be very careful in these days, in present circumstances. It is critical that you take independent and direct opinion from entities' legal consultants. So there may be situation that a lot of legal cases are going on, and many times the company, the client, they themselves are not aware that how many cases are going on. So you need to have a discussion with the legal consultant or the legal department of the organization to get a comprehensive list, and then you need to do a cutoff testing. So we were doing audit of a large entity, and we realized that their legal department gave us a list that, okay, these are 26, 27 cases which are running. And then the audit team, when they were looking into the board minutes, they realized that there was another case which was not mentioned in the list, but which was there in the board. There was some discussion happened. So when they cross-tell it, they realized that the list which was provided by the legal department was not complete. So when we raised this issue with those charged with governance, they took appropriate action, and they asked the team to revisit all the documents, and they also strengthened their own internal controls in that manner, because promoters were very happy that at least there is some value addition which is coming out of the auditor, because even I need to have a total control on what kind of cases are going on in my organization. Then key estimates and assumptions, standard on auditing 540 also gives you guidance on that. But you need to keep a memo. You need to keep your work papers in order, showing that the procedures which were carried out, they were testing the reasonableness of the estimates and validating the assumptions which were taken by the bank, by the clients. So large number of people, they are doing bank audits nowadays. And while we are talking, there are people who have gone to the branches to do the audit of those branches of the banks. And there are many people who are doing audit of those private companies. But at present, the bank audits are going on. So when you're looking at the estimates and the assumptions of the banks or the branches, you need to create those kind of memos, and you need to demonstrate that whatever assumptions banks have taken, there have been some basis for that, and that basis you can challenge, and only when you're getting comfort, you are accepting that transaction in the financial statements. And in your work papers, you need to have a memo demonstrating that the assumptions were actually challenged and were according to the comfort of yourself. Then when you're preparing financial, completing the audit, and when you're preparing for report, you need to have an assessment of whether the audit which was planned was carried out according to your planning. Your audit procedures were carried out according to the planning which you had done. What were the significant issues and how those issues were concluded? You need to have your work papers, your management representation letter, and please remember that MRL or management representation is not the ultimate evidence. It is just an additional representation. Whatever is mentioned in the representation, you need to audit that as well. And then subsequent events, after you have carried out the audit and the time in between, the time when you are signing off the audit, anything happened in between, you need to have a written representation from the company or the client that whatever happened in the subsequent event. You need to have a documented communication with those charged with governance. And in case you are also reporting on CARO, you need to have a separate work papers demonstrating that you have actually carried out the audit, and whatever information is, whatever questions were asked in CARO, you need to have an answer in your work papers. And whatever deliverables you are giving, you need to have, complete documentation around it. Now, what are the significant issues? There can be business risk, there can be, assertion risk, there can be fraud risk. So these are the significant issues on which you need to have a very clear understanding from the client. And legal cases, litigation, estimates, critical accounting on audit matters, identify. So basically, you may identify the company is doing hedge accounting. Company is doing the hedge, but the accounting is not done accordingly. Then how are you going to tackle that? So a company may say that we are doing a very simple accounting and we are not getting into the complication. So whether you are looking at the difference between the kind of accounting which the company is doing and the kind of accounting which accounting standards are proposing, and whether that difference is above that materiality level or not, and whether that goes in a direction of non-compliance with the accounting standards or not. So there are some points on which you might need to have a consultation. So you may go to the third party, or you may go to an expert to take an opinion from them. So an example I had given was, actuary valuation. So you need to have, in case you want to discuss with them, you need to have a documentation, talking about the kind of issues which was there and how it has been closed. Then in case you are trying to modify your report, you need to be more careful, because modification, emphasis of matter, key audit matters, these are all part of your audit reports, and which point has to be put in at what place, you need to be very careful about. And you need to have a very clear understanding why this point is going to be reported under modification or a qualification, why this point is not a qualification, it is only emphasis of matter paragraph, and why this point is important to be disclosed in key audit matters. So when you're talking about key audit matters, you may talk about revenue recognition, and you may get into explaining what you have done. But please remember, you're not giving again an assurance about the revenue recognition in key audit matters. You are talking about key audit matters only there, because in any case, the assurance which you are giving is, in the opinion paragraph. Then working note on those significant issues, like issues involved, like for example, in case you are having engagement quality review. So what are their views, and what are the response received from the client? what kind of audit memo you have created, and what kind of issues you have captured there. Representation letter, I have already talked about it. Standard on Auditing 580 talks about getting the management representation. Many times what we have seen while doing the reviews of or doing the peer reviews or doing the FRRB reviews, we found that representation letter actually contains similar thing as they have been mentioned in the notes to accounts of the balance sheet or the profit and loss account. So please remember, the representation letter has to be very specific, and it need not repeat everything which has been already mentioned in the financial statement. So the key matters which are confirmed or replied by the management should maybe included there, and it is critical that you get that letter signed from appropriate authority from the company side. Subsequent event, I have already mentioned, COVID situation might have a significant impact, and now as March 31st, 2022 ended, so you need to, when you sign your financial statement, please ensure that you are taking those instances which have subsequent events which have happened after 31st March. And especially when you're reporting under CARO, so you have to give a specific report on various clauses, new clauses which have been given in CARO. So please collect information which is related to the event which have happened after 31st March and before your signing date. So Standard on Auditing 260 mentions about those charged with governance, communication with them. It has to be on timely basis and it has to be in writing. So minutes of the meeting has to be there in your record, in your financial statement, auditing work papers. So please do not take it lightly, because regulators are looking into this as very important aspect, and even the audit committees and people who are at the, those who are charged with governance, they are also looking at your inputs as auditors. So when you are doing audit of under the Companies Act, section 143(2) very clearly mentions that the auditor shall make the report after taking into account the auditing and accounting standards. So the auditing standards are now part and parcel of the Companies Act, and you cannot ignore it. Earlier, the auditing standards were in the kind of guidance, but now under section 143(9), if you read, every auditor shall comply with the auditing standards. So it is part of the Companies Act itself. So the AASP has given various kind of guidances. So which are the services, whether you are giving assurance services or whether you are giving related services, you need to ensure that you are complying with the standards. So when you are doing assurance services, the chances are that you are giving your opinion on historical financial information. Or when you are doing assurance services, you can also be giving them other than audit and review of historical financial statements. There are various standards which are there. So you need to look into these standards and ensure that these guidance which have been given by these standards have been properly complied with. So going to the to summarize the AASP guidelines, there are different kind of standards. Engagement quality related to historical financial information when you are expressing an opinion, standards on auditing, review engagements, and other engagements, and agreed upon procedures. So you need to ensure that you are independent while carrying out the audit, and it is not independence in appearance only. You have to ensure that your independence is according to the independence of mind as well. So professional skepticism is a critical part when you are doing the audit. While doing the CARO reporting, please ensure that the new requirement, your team is properly trained, and you are looking into the areas which are required by the new CARO. So basically your work papers, your documentation should be enough so that it should be able to enable an experienced auditor who has got no previous connection with the audit to understand what you have done. So like I had mentioned that, your file should speak by itself. So basically what any experienced auditor, he should see the nature and timing and extent of audit procedures, the result of audit procedures and significant matters. They are all have been documented properly. So when you are doing audit, the quality has to be ensured, keeping in mind the size and complexity of the entity, the risk of identified risks, then nature of procedures performed, the significance of audit evidence cannot be undermined. Audit methodology and tools which you have used have to be taken into account, and nature and identified exceptions during the audit. So your audit work paper should talk about all of these. So with this, I think I've completed my time. So thank you very much for giving me this opportunity. I hope this was slightly useful for you. Thank you so much.
Thank you so much, sir. Thank you so much for this wonderful and detailed explanation. We are having with us our Vice Chairman, sir, Vishal Doshi ji.
Thank you, Parveen ji.
Vishal sir, can you minimize the presentation kindly?
Sure.
So we are having with us our Honorable Vice Chairman, sir, Vishal Doshi ji. Over to Vishal Doshi, sir, Vice Chairman, sir.
Yeah. Thank you, Parveen ji, for that wonderful presentation. Sir, there is a question that when third-party confirmation is not received, then what would be the responsibility of the auditor as far as the audit report, whether there would be any qualification or whether any statement of facts, emphasis should be done by the auditor?
So Vishalji, these procedures, they are there to enable auditor to get a comfort that the opinion which they are giving, whether that opinion is having some kind of substance or not. So in case third-party confirmation have not been received, there is always an alternate procedure which the auditor can perform. So let us say there is a receivable of a particular X amount, and the auditor sends a letter third-party confirmation, saying that please confirm on 31st March, X amount was to be received from you, and response doesn't come. But he can always look into the ledger and he can see that on before signing the financial statement, the amount has been received from that client and the amount has been nullified. So he cannot say that the amount is incorrect. He can carry out alternate procedure and look into the number, whether that number is showing true and fair picture or not. So primarily, the role of auditor is to get an evidence to provide reasonable assurance to the users of the financial statement. So there is a primarily, the first activity that person will do, the audit procedure. Then if that procedure is not able to give comfort, then the alternate procedure can be done, or the third alternate procedure can be done. Even then, if he is not able to get any evidence or not able to get comfort, then he should consider whether this amount is above materiality level and whether it is appropriate for that person to put a modification in the report. So that's what my response is.
Yeah, thank you, sir. The next question is where I would also partly answer that, and I would request also you also to kindly supplement, is with respect to use of the audit tools for documentation and all, and for especially for the small and medium enterprise vis-a-vis the small and medium practitioners. So from the ICI side, I would at least say that we have this year, I would say, a committee which is working on the audit tools and the audit templates and audit checklists and all, which we are planning that in the near future we would make it available for the small and medium practitioners. So that would cover some Excel files also, which can be used. In addition to that, there would be some standard templates also which would be available, and also legal referencing at one point, which would be there. But Parvinji, till that time that we are able to launch from ICI, maybe you can guide the participants about what is the best way they can ensure that the compliance with the standards on audit is being done by them.
So, Vishalji, I agree with you. The tools are very important nowadays for small and medium practitioners, as well as large and very large, practitioners also. For people who are doing, let's say, large, very large and complex audit, it is inevitable that they use the audit tools. But smaller practitioners and smaller entities for which we are doing less complex entities, I think the best tool which is available is the MS Excel. I think Excel can provide you so much of information. And nowadays, the information is readily available on the YouTube. You can just open YouTube, how to check and what to check. For everything, there will be a lecture, there will be examples which will be there. So I think the best tool for small and medium practitioner and small and medium entities, less complexity entities, I think the MS Excel is one very, very powerful tool for doing the audit. But yes, there can be other tools also which can be used. But like, you have mentioned that the institute is coming up with a tool which can be used to do various kind of analyticals. And also there are tools which are available in market for sampling. There are tools for documentation. But I think what is critical out here is that the auditor should be in a position to demonstrate that audit procedures were performed. That is the end object, whether you use the tools or whether you do it manually. But if you have written on a piece of paper that, okay, this is what I have done, and this is where I did not find any, reconciliation was done, or till the time the auditor is documenting whatever is being done, I think it should be okay. But yes, tools are very, very important nowadays.
Yes, sir. I think you mentioned a very important word about audit documentation. And I feel as auditors in our office, we should have this written that whatever is not documented is not done, which is the principle that all of us should follow. Sir, just one last question. That materiality you mentioned, in case of loss-making company, how can the materiality be quantified?
I think this,
or especially in the initial years. Yeah.
We'll leave it to Vishal Sharma ji, because he's.
Yeah, I know. He's going to take it up. Fair enough, sir. Yeah, thank you, sir. Thank you for that wonderful session of yours with your presentation. You gave a lot of insights into the topic, and I believe that with your deliberation today, a lot of us would be now moving towards some very basic elementary documentation to start with, moving step by step, and maybe down the line with the ICI also coming up with this audit tool software. We would venture into the area where I would say almost all of us now standards on audit compliance. So thank you, sir, once again for your valuable time, for sparing your time with us. Thanks, sir. Yeah, friends. So we move on. Yep. We move on to the next session on audit materiality, and I would request Vishal Sharma ji to kindly enlighten us with the materiality aspects of covering an audit.
Sure. Thanks, Vishal. So I'll just share my screen and just let me know if that is visible, so I can just start.
Yes, sir.
Okay. So good evening, everyone. I'll just speak about SA 320, which is about materiality in planning and performing an audit. This is a, if I just start with, and I know that there is a question from the previous session, which is pending to be answered, and I'm sure, during one of my slides, I'll be able to cover that, which is a specific question on materiality for a loss-making company. However, just to start with about this particular auditing standard, the starting comments are that this is a fairly simple standard to read, but equally complex to apply because of the requirement of the professional judgment over there. The reason is because when we talk to the regulators, when we talk to the quality reviewers, maybe if I talk about my experience being reviewed or my experience, dealing with some of the regulators, not only in India but also internationally, I think so. If materiality goes wrong, everything in audit goes wrong. So that is the basic principle. Because if you don't set your materiality right, then it's quite likely chances that as an auditor you get challenged a lot from the regulators also, as well as the reviewers who are going to look into the quality of your files. And this standard, as I said, like it's a fairly simple standard. It only cross refers to few of the other auditing standards. SA 200 is one of them, which talks about the overall objective of an audit to be done by independent auditor, and a couple of others, including 315 and 450, which is about assessment of misstatements in an audit. So let me just start talking about that. I think so I will have around 11 or 12 slides to walk you through this entire standard. As I said, this is a really simple standard, a 10-page standard to be very precise. If you look at the base standard. So let me just talk about some of the concepts of this standard. So introduction as a scope. So this standard deals with the auditor's responsibility to apply the concept of materiality in planning and also performing the audit of a financial statements. Okay, so that is the overall scope. The purpose of materiality in an audit, though it's not been defined in the standard or prescribed in the standard, but I think so what it is referring to is that there has to be a magnitude of an omission or a misstatement, which is expected to influence the economic decisions of the users of the financial statement. Now, users of the financial statements can vary a lot depending upon the type of the company, the ownership of the company, etc. And we'll talk about that in the subsequent slides. However, again, just to reiterate that the materiality is the magnitude of an omission or a misstatement, which the auditor has to be mindful of, while planning and performing an audit. The objective of this standard is that the auditor has to apply the concept of materiality appropriately. As I already said, that if this is the starting point of not the very, very starting point, but I think so one of the critical points in your overall plan or a risk assessment step. If this goes wrong, there are a lot of chances that the things get challenged. So the auditor has to apply the concept of materiality appropriately in planning and performing an audit, including determining the nature, timing, and extent of the risk assessment procedures. So what are the risk assessment procedure is that to what extent you have cover your various accounts in our financial statements. There can obviously be some accounts which are very, very of a small amount, risk-free accounts, maybe if it's a company which is barely takes any properties on rent, so rental expense can be a very, very small amount. It's just a per month a multiple of 12, no risk element into that. I think so. Those are some of the examples. However, for a consumer product company highly into the market, like maybe a refrigerator company or a company into appliances or a company into any other consumer product, revenue would definitely be a highly risky area because of the wide spread out of the revenue procedures of the company. So the risk assessment procedures are also very critical, and the materiality concept equally applies in the risk assessment procedures as well. Now, when we talk about materiality, there are two levels of materiality which have been defined in this particular standard or have been explained. One is the materiality for the financial statements as a whole. And we'll talk about that because the larger chunk of the discussion is on the materiality for the financial statement as a whole. And the second element is the performance materiality. And this is the verbatim, which I picked from the standard. Performance materiality is a subset of the overall materiality, and it is required to address the risk for any possible undetected misstatements. Okay. Now, slightly, I would say the way these terminologies has been used, one has to be very careful, and I also discuss in the subsequent slide the concept of the misstatements and the classification of misstatement is here just to give you an brief view of the misstatement is that a misstatement can either remain undetected, which would mean that in spite of my audit procedures, I am not able to detect the misstatement, or the misstatement has been detected, which can further split into two buckets. One, which has been corrected by the client, or has not been corrected by the client. Okay. So just to reiterate, misstatement, undetected or detected, and detected can be corrected or uncorrected, and we'll talk about these in greater detail in the coming slides. Okay. The only definition in the standard is on performance materiality. The standard does not define what does it mean by the materiality for the financial statement as a whole. However, the larger discussion in the subsequent slides and also in the standard is on the overall materiality. So what does a performance materiality means? It means the amount or amounts which has been identified by the auditors and which is less than the materiality of the financial statement as a whole. As I said, this is a subset of the materiality for a financial statement as a whole. And what is the purpose of performance materiality? The purpose is to reduce at an appropriately low level the probability that the aggregate of uncorrected and undetected misstatements will exceed the materiality of the financial statement as a whole. Now, if you look at this particular definition, and this is again a verbatim of a definition from the standard, I've just broken into different lines just to make it more clear. Okay. So the first point is that it is a subset of the overall materiality, and second is that this will help the auditor to reduce the probability of any uncorrected and undetected misstatement in totality exceeding the materiality of the financial statement as a whole. Okay. Now what does this mean is that say for example, if my materiality is based on the profit before tax and it comes out to say 5 crore, then and I have a whole lot of uncorrected misstatements, okay, which are not which are like touching say for example 2 crore. Now am I comfortable if I put my performance materiality as my overall materiality? The answer is no, because I have already identified misstatements worth rupees 2 crore. So I just need to make sure that my performance materiality should be a number which should take care of the uncorrected misstatement. The second leg to it is that what about the undetected misstatement? Now the volume and the value of the uncorrected misstatement also gives me an indication that there can be certain undetected misstatements as well. Okay. So I need to set my performance materiality at a level which will take care of at least the undetected misstatements, because the uncorrected misstatements I have already identified and I can assess the implication of the uncorrected misstatement vis-a-vis forming an opinion. Okay. And we'll talk about that in with some examples as well in the coming slides. This is just the definition. What I've mentioned in yellow over here is that when you determine a materiality, it does not mean that amounts below your materiality either individually or in aggregate will always be evaluated as immaterial. Now in the given example, if my overall materiality is 5 crore and I get maybe 15 instances where the misstatement is ranging between 40 to 50 lakh. If I aggregate all of that, this will definitely increase 5 crore. Okay. So I will have to, be cautious about that. If my individually, smaller amounts below materiality, should I aggregate or should I not aggregate? I think so. I have to be very, very cautious about that. And that is the reason I said that this standard is very highly judgmental to apply, because just setting a number as a materiality does not mean that, we are comfortable with anything which is below the materiality. Okay. So let me just move forward. What is materiality in the context of an audit? And so this was being discussed before the sessions by, that the financial reporting frameworks, also discuss the concept of materiality. Okay. For the preparation and presentation of financial statement. And what does it talk about is that the misstatements, are material if, they are expected to influence the economic decisions of the users. Okay. Here, I have underlined the word users because it's more from the point of view of the users, and users can be, different parties, and we'll talk about that. The second important point is that the judgment about materiality are made in the light of, surrounding circumstances, which would mean that, again, what is the type of industry, what is the nature of industry, what is a particular year impacting this type of industry. We have seen some of the industries, very hugely impacted in the last couple of years because of COVID. Hospitality industry, the hotels business is one of those. So that is also the factor to be considered. And the third one again is that the judgment about matters that are material to the users, will consider the common financial needs of a user as a group. Now, what does it mean that as an auditor, I'm not going to look about any specific individual user, that what does the individual user, will consider the materiality. I'm going to consider for the common financial information uses of a particular entity, and that is a group. So for example, investors, for a public interest entity, the investors, the shareholders, which also include the FIIs, which would be a common group of users, and also say for example, analysts who are using the public information to benchmark a particular company against other companies. Maybe it's a consumer product or automobile industry. So those are the common group of users. So I'm as an auditor more concerned about the judgment, which is material to a group of users rather than going for an individual, user. So this is again the context which has been given in the standard about, the concept of materiality. Now, what does the standard actually covers? The standard covers three different buckets. One is you need to have a materiality at a financial statement as a whole, which is for the overall financial statements, and this materiality can be lowered for some specific, class of transactions or account balances. Again, this is not a must to have in an audit file or in audit engagement. This can be on a specific case-to-case basis. So, say for example, in a group where we are auditing as a group, there are very numerous related party transactions. Now, one of the entity which we are auditing, the larger chunk of sale goes to the group companies. Now, and at a console level, at the group level, it knocks off, but at a standalone entity level, for which we are issuing an audit opinion, this transaction is a very specific class of transaction, and for that we may decide that we need to have a materiality which should be lower than the materiality of an overall financial statement level. Yeah. And again, this will depend upon industry to industry. The third element in this standard is that materiality is not only set at the beginning of the audit. As the audit progresses, the auditor is expected to revisit the materiality, and also at the end of the audit, when we are actually concluding the audit, we should revisit the materiality, that the materiality which we have used, does it still make sense, or it it has materially changed, that will give me or require me to perform certain additional procedures. I think so those are the things. So an example could be, when I set my materiality, the profit before tax, given to me for a public company was, say, for example, 100 crore, and I set a materiality of 5 crore. Okay. Now, when I finish the audit, the actual profit, because of the finalization of the financial statements, and various adjustments which the client has passed, so and so forth, the profit before tax reduced to 80 crore. Now, if I apply the same percentage which I've applied in the beginning, my materiality at a financial statement level reduces from 5 crore to 4 crore. Now, am I happy with the procedures done? Am I happy with the amount of or the volume of samples which I have used? I need to revisit, reassess, and confirm. And if there is a need for additional samples, I need to have those additional samples tested and documented in the file to mitigate the risk of any unaudited portion of the overall coverage which I need to give in the financial statements. I think that is the concept which is being spoken about in this standard. Now, we as an auditor, all of us know, and I'm just referring to the third bullet point over here, which is the audit risk. There is a formula of risk of misstatement, which we also term as inherent risk. There is a risk that the controls of the entity does not work effectively. That is the control risk. And the third risk is that, in spite of our best audit procedures, we still miss out some of to detect some errors. So that is the detection risk. So my overall audit risk is a multiple of my inherent risk, my control risk, and my detection risk. Now, with the overall objective which we as an auditor have, which was being mentioned earlier also, that we need to provide a reasonable assurance whether the financial statements as a whole are free from material misstatement, including due to fraud and error. Okay, and that is the reason there is a concept of materiality, because the client is doing their accounting 365 days a year, and we are there to audit maybe say for 1.5 months, 2 months, 2.5 months at max, maybe depends about the company or the size of the company. So we do everything on a test check basis, sample basis, inquiry basis, etc. That is the reason we also apply the concept of materiality. So the concept of materiality is applied by the auditor to plan and perform the audit, and to evaluate the identified misstatements and also of the uncorrected misstatements. Now here what you see is that the identified misstatements is not talking about the undetected misstatements. So as an auditor, we can only evaluate the effect of the identified misstatements and the misstatements which, in spite of being identified, have not been corrected by the client on the financial statement as a whole when we are forming an opinion. So that with that concept of materiality and the concept of audit risk, it is a combination of materiality and audit risk which has to be considered all throughout the audit. Okay, I will always be skeptical about the audit risk which I am carrying while I'm performing the audit. I'm also cautious about the concept of materiality which I'm applying, and a combination of that will help me to identify the risk, to determine the nature, timing, and extent. Extent means the number of samples which I want to check, or any further audit procedure which I want to do, and also finally to evaluate the uncorrected misstatements which I have already identified as a part of the audit. So these are the broad concepts which this standard talks about. Now let us move forward and see actually how the standard supports us to determine materiality. Now, in determining materiality, the first step is that we need to understand that who are the users of the financial statements. Okay, and then to also understand the perspectives and the expectations of the users of the financial statements. So what should we do as an auditor? Okay, we should first step identify who are the expected main users of the financial statements, and this will be based on our understanding of the entity and also our discussions on, rather I would say, continuous discussions with the management and with those charged with governance to better understand that who will be the main users of the financial statements. And then the second step would be we need to consider as to what we as an auditor apply the best possible professional judgment to identify that this would be the expectations of the users of the financial statements about materiality. Okay. So these are the two basic elements which which is a starting point when we talk about determining materiality. Okay. So who are the main users of the financial statements? So the main users of the financial statements may include one or more of the list which is there on the screen, which can be the owners of the entity, shareholders. Shareholders for a public company is a wider population of shareholders, including FIIs. For a private company, it can be one single shareholder as a parent company, or it can be maybe a couple of shareholders who are there. Then there can be investors like private equity investors, etc. For a company which has investors sitting in. Owner of the private held entity, as I've already talked about. The other set of users can be the major lenders or the bondholders. Lenders could be your banks who are giving you loans, and specifically we need to be very cautious in the very highly leveraged industry. What are the expectations of the lenders are from the company. Regulators, specifically like pharma company, it's a regulated company. Fertilizer company is a regulated company, and so forth. If there are any regulators which are actually looking at a particular industry sector, so we also need to focus on that. Analyst, as I already said, these are the people who analyze each and every listed company, benchmark them. You see a lot of information which the analysts publish on various websites. And you also get to know what type of information they are more focused on, and this is also relevant. I can just quote an example that every listed company does an investors call after every quarterly results. So as an auditor, we need to be looking into what type of discussions are happening in those investors calls, just to be familiar with what type of users we are looking at, and what is that they are looking from a company. Other stakeholders in some jurisdictions, it can be largely the private companies where there are employees, specifically if the employees also get ESOPs, etc. And then there can also be some suppliers or customers depending upon the nature of the particular company, and tax and legal authorities are definitely other one. The other part which becomes very, very important, and it's also the requirement of auditing standards, where we are supposed to interact with those charged with governance. There also it briefly specifies that as an auditor we need to have expectations from those charged with governance with respect to materiality. We're not telling them the exact materiality, but checking with them as to what do they believe would be material from a financial statements point of view, and also documenting that. And the second part is about the characteristics of an entity, like what is the type of the company, what is the maturity level, is it like a stabilized operations or a newly set up company, or what is the objective of the company, is it like a profit oriented company or a not for profit, is a cost plus entity, etc. And industry sector obviously is going to play a relevant role, specifically in times what we have seen in the last 2 years, where a lot companies had suffered a lot, and some of the companies including say pharma companies did not see any impact of COVID. Rather they grew a very high percentile as compared to other companies. the first step, as I spoke about, is identifying the users and categorizing them, and also talking to those charged with governance. I think so. The note below what says that as an auditor, I think so, when we identify the users of the financial statements, we are definitely assume that these users have a reasonable knowledge of the business of the company, okay, and the economic activities in which the company is, and they also understand the financial statements of the company, and also understand that the financial statements are prepared and presented and audited with respect to certain materiality levels on, okay. So they are also aware that it's not the auditor is not there to give a true and correct opinion on the financial statement. We are just giving a reasonable assurance, which is a true and fair opinion. And they also recognize, uncertainties which is inherent in, measuring the amount based on estimates. So every company, have one or the other estimates. It can be, highly sensitive estimate. It can be a very normative estimate, like a depreciation or a gratuity or something like that, vis-a-vis mark to market for a derivative, highly complex derivative contract. So I think so they also understand that there are inherent limitations or uncertainties which are there with respect to some of these estimates. So I think so we, as an auditor, if we assume them that, and we also document that in the file, I think so that is a very good practice to do about identification of the main users of the financial statements. Moving next is determining materiality. Okay, now once we have identified the users of the financial statements, we also have to determine the materiality. Again, it's also a lot of professional judgment. So we'll have to pick the right benchmark, and we'll have to apply a percentage. Okay. Now, what are the benchmarks? So when we have to identify the appropriate or the most appropriate benchmark in respect to an entity, the factors which we should consider include, the elements of the financial statement, like, the total assets, total liabilities, equity, revenue, expenses, etc. Items on which attention of the users of the entity's financial statements tend to focus, like the financial performance indicators, such as profit. So highly profitable company, a growth company, what is the expectations of the market from the profit, and in a growth company, what are the expectations of a revenue growth, etc. A real estate company can also be about the total asset base, because they're largely land banks or setting up new ventures, etc. So this is also some of the items which need to be focused upon. The life cycle of the entity, I think so. Is it like a newly set up entity, a matured entity? What type of industry they are operating in? What is the economic environment? That is also very, very relevant. So that is there. The other one is about the ownership structure. Is it like financed by equity or by debt, etc. I think so. These are the items to be looked on when we have to go to the benchmark. And then obviously the last and the most important one is that we may look at the benchmark, which maybe is profit, but if the profit is volatile, then is it the right benchmark? If the revenue is volatile, is it the right benchmark? I think so. We also need to be cautious about that. Once we have identified the benchmark, there is a percentage, which has to be applied on the benchmark as a starting point to say that this is the materiality for the financial statements as a whole. Okay. Now, let's talk of some of the examples of benchmark, and maybe I'll try to answer, one of those pending questions which is still there. So the benchmarks, can broadly be classified into three different buckets. One is your earnings based, the other one is your activity based, and the third one is your capital based. Now, what does the guidance says that profit before tax is often used for the profit oriented entities, and it also says that if the profit is volatile, I'm sorry for the light, if in case the profit is volatile, you need to adjust that for some one-time exceptions, or alternatively normalize the profit, if possible, and if not, then go to some other benchmark. So now let me say that if you are auditing a company which has been historically into profits, and it's a comparable profit benchmark to similar industries, and all of a sudden you see that the profit has drastically dipped, or it is like a near loss situation. You'll need to investigate, what are the reasons for that. Is there any one time, maybe some restructuring or one time loss, which has been booked? You may eliminate that. That is not your usual exercise, because in any which case, for that one single significant item, you will be performing, a whole set of audit procedures to make sure that this item has been adequately accounted for. Example is that a lot, the sale of a subsidiary at a loss. It's a one time. So company is not into a business of selling subsidiaries. Okay. So that was one of the, can be one of the examples. Now, if there are no one-time exceptions, can we normalize the profit? Normalize is that, like, um, uh, usually the company, if the company was able to sell this particular volume, they will earn X number of profit. However, this year, because they were not able to sell because of the obvious reason beyond the control of the company, so the profit number got dipped. So if we can just go and normalize, but we have to document very, the very critical rationale of as to why we believe that this was, if the circumstances would not have been there, the company would have definitely sold what they would have budgeted or earned what they would have budgeted. So we would be using a normalized PBT. We are not going to unnecessarily reduce my base for determining the materiality. Okay. Now, the question which was coming up for a loss-making company. So if it's a loss-making company, historically the company is in losses, and I'm assuming that this is not a public company. This is a private company. In that particular case, if the users, say for example, if the company is leveraged, you're going to look at what are the loan covenants. The loan covenants would be the headroom, and the bank would be more likely worried about the headroom available with the company to pay off the installments and service the interest. I think so. In that particular case, EBITDA can also serve a better purpose. And if just in case you believe that EBITDA is also not available, and obviously EBIT will not be available, gross margin is also not there, the next step would be, then okay, then let's talk, go and consider revenue as the base, because obviously the company is into operations. It has not yet reached the scale which it would have reached, or that is the reason it is not earning the profits. So I think so you can also move to revenue in that particular case. So again, I have just answered the questions, or tried to answer the question, just to assuming a particular fact in a company. Maybe there are multiple other facts. Maybe it's a public company. It's not a profit-making public company. So you'll have to go and see what does the company speak to the investors in their investors call. Are they looking at EBIT, EBITDA, gross margin? Are they focusing? It's still a revenue-based company. It may not be, because if it's a listed company, it may not be a revenue-oriented company. It would be more likely a profit-oriented company. So that is where you have to go and do a deep analysis of the benchmarks after identifying the users, and then to say, okay, this is my basis for setting up the materiality. Okay. Now, what do you use? What is the data which you use to for a particular chosen benchmark? Which you should consider before you apply a percentage. Now, the prior period or a prior year financial results or a financial position are known to you because you have been auditor. Even if you are an incoming auditor, you have full right to go and look at those. The YTD financial results are available for you, and also the budgeted forecast. And again, the budgeted forecast have to be authenticated, at least by some senior level management person. My personal request to my clients is that I will only rely on the budget or a forecast which has been approved by the board. Okay, because as an auditor, when I am addressing my opinion to the members of the company, it's the board who is actually acknowledging the financial statements along with me. So merely getting a budget signed by maybe a CFO, just a CFO, may not suffice. You may still get challenged. Okay, until unless the board has assigned him to sign on their behalf and give those to the auditors. But again, the budgets has to be authenticated. That is a very critical element of that. And also need to consider any relevant changes of conditions in the industry or the economic environment of a particular company. Okay, now say for example, nowadays because of these commodity pricing increase, we just need to be cautious about what would be the year-end number. Now obviously we are already crossed the 31st March, but maybe so some of the non-listed companies you still not have got the final numbers. But I think so we just need to be cautious about what are the conditions or the environment in which the company is operating, and are there any impacting changes to that. I think so we need to consider about that. And the last line which says that we may also have a situation where we are giving an opinion on the financial statements which are less than 12 months or more than 12 months. Your materiality has to be for the financial reporting period. So if you are giving an opinion on 9 months financial statements, you have to consider 9 months numbers for applying materiality. The other concepts remains the same. Okay, now the next step, as I said, or the third step, after identifying the users and then the right benchmark, is to apply the percentage to that benchmark. Again, it's a professional judgment. The standard though gives two examples. One is for a profit-oriented company. It says that for a profit before tax, which was your earnings based, the first earnings based, benchmark, you will be applying 5% of the PBT. Or if you are going to total of revenue or total of expenses, you can use 1%. Now this is maybe a indicator. It cannot be sacrosanct. You can obviously increase from 5% of PBT, maybe to say, my personal opinion would be to say 8%, 10%, depending upon the company. If it's a private company. For public company, I think so 5% is a very decent percentage, and we don't see any reason why to increase beyond the 5% of PBT. And so is the case for 1% of revenue and expenses. For other measures like total of assets, total of equity, maybe 0.5% to 1% is something which can be there. Again, I think so. As an auditor, what you need to visualize and analyze is that what would be the normative revenue, normative profit of the company, which has been for which the company has been set up. Okay, now if you talk about the normative profit, I understand that for the last 2-3 years there is no normative revenue coming in, there's no normative profit coming in. But if a similar sized company with a similar sort of a revenue and a profit, you apply a materiality and you get a X number. Now, if you don't have a PBT, you don't have a EBITDA, you go to revenue. But if you apply a percentage of revenue, and if you compare to the amount which you have derived basis the profit, if based on revenue it is coming 2x, then I think so fundamentally something is wrong. Either in our estimate of what would be the normalized profit of the company, or we are going too aggressive by applying a percentage to revenue. Maybe in that case we have to reduce it even below 1%. Nobody challenges you. Obviously nobody will also challenge you if you increase beyond 2% till the time you have a rational put in over there. I think so. The other important point over here is that the higher or the lower percentages as compared to what has been given may still be appropriate in different circumstances. Specifically if I talk about a public interest entity, which is a listed company or an unlisted company, okay, where there's only one single shareholder as a group, as a parent company. So you'll have to keep some of those factors also there. Some specific considerations which have been set in the standard is about small entities, which is like where it's a one single owner. It's a like company where he himself takes care of the lot of the stuff. Maybe profit before the owner's remuneration and tax is more relevant. For certain central and state governments, maybe what is more required by the legislative and the regulatory requirements can be looked into, because those central and state governments are not widely looking at profitability, etc., of those entities. And same is the case where some of the public utility programs and projects which the entities are doing, where maybe they're more focused on total cost or the net cost rather than profitability. Okay. The concept, what we have spoken about, the materiality on the overall financial statement level can be drilled down to a particular class of transaction or an account balance or a disclosure level. Okay, I'm not speaking about performance materiality over here. That is in the next slide. I'm just talking about, like, the benchmark of PBT and a percentage of 5%. That is the overall financial statements. However, for the standard says that for some of the specific cases, as the examples have been given, that where the company has very high number of group company transactions. So for the related party transaction, you can set up a lower materiality, for this particular class of transaction, or for a disclosure for a pharmaceutical company where R&D cost is a very key disclosure. You can set up a lower materiality for those disclosures. And so on and so forth. I think so. In all these cases, these are the specific circumstances of the entity which has to be considered by the auditor to identify if there are any class of transactions or account balance or disclosures where a lower materiality has to be set. Again, this will not be a must to have, or should be there in each and every audit, but you will have to address whether or not this impacts or applies to your particular audit or not. Now let's talk about performance materiality. I think so. I already spoke about uncorrected misstatement and undetected misstatement, because the corrected misstatements have already been corrected in the financial statement. Now what is the requirement of a performance materiality? The performance materiality says that there can be individually, individual items which are below my overall materiality. Okay, if I ignore them, they may in aggregate cross the overall materiality. Okay, that is one risk. The second risk is that there will be no margin for any possible undetected misstatements. Okay, so that is the reason there is a need for a performance materiality. So when I set up performance materiality, what do I do is that I actually reduce the probability that the aggregate of any uncorrected misstatements which are known to me and undetected misstatements which are not known to me may not exceed the overall materiality. Okay, so say for example, if I have a overall materiality, and my aggregate of uncorrected misstatements is say 10% of my overall materiality. Now I still have a window, that okay, 90% till 90% I still have a cushion. So if I set my performance materiality at 75% of my overall materiality, I still have a cushion of 13% for my undetected misstatements. Okay. In another example, if my aggregate of uncorrected misstatements is, say, for example, 30% of my overall materiality, and then I am just left with 70%. Now, if I set my performance materiality, say at 50%, I still live with a cushion of 20% for my undetected misstatements. Now, those are the concepts. Now, these percentages are my personal opinion. Like, we can't have like percentage for performance materiality. Okay, let's put it 90% or 80% or 85%. I think so. We should go down by different levels. Maybe I would say reduce the overall materiality by 25% or reduce it by 50% to apply the concept of a performance materiality. Now, where is the performance materiality used? So the performance materiality is used when you actually design your audit procedures and identify your samples. Okay, there is where your performance materiality will be used. Now, and the same concept will apply to if you, as I spoke in the earlier slide about a particular class of transaction or an account balance. Okay, and the performance materiality is very categorically, I would say, is not a simple mathematical calculation. It requires a lot of professional judgment. Now, you will also have to say what is the amount of uncorrected misstatements which I am aware which were there in the previous year, and since now I am into the second year or a third year, I can also identify that okay, there are some items which remained undetected in the previous year. So what is the reference I'm drawing? Okay, so in the earlier examples which I have quoted, where the uncorrected misstatements were 10% or 30%, I think so these are the indicators which you will be using to set your performance materiality. That is the broader concept about a performance materiality. Okay, your history of previous audit is very, very relevant. Now, in the first year audit, because this country is already in audit rotation, and for the listed companies or also some of the non-listed companies, it will obviously become a challenge in the first year of an audit. So I think so you'll have to be very, very skeptical to in the first year of audit to keep your performance materiality at a lower level, say 50% of the overall materiality, just to make sure that you don't end up into any surprises either at the end of the audit or in the next year when you see any undetected misstatements being reflected in the next year's audit. I think so that is the main point I would like to address on this particular slide. Okay, this is the last part of the session, is that the first is on the revision of the materiality. I think so it can the changes in the circumstances can obviously occur. I have done my interim audit. I took December numbers. I took the budget for the next three months. There has been a drastic change in the budget, which was given to me vis-a-vis actual. So I need to, or there are some new information which has come to my attention, which I should have considered to while assessing the materiality. I think so. All those revisions have to be, taken care of, and reassessed at the time of setting up the, materiality, and reassessing at the end of the audit. And the last one is, again, it's coming from the quality standard, but it's very much written in this particular standard, and as other standard as well, that it has to be adequately documented. Okay, so our documentation should definitely include, what is the materiality state of the financial statements as a whole, and if applicable for a particular class of transaction, what is my performance materiality, and also document any revision to the overall materiality or the performance materiality as the audit progresses till the conclusion. And again, it's not that we just need to give that my materiality is 5 crore, my performance materiality is 3.75 crore. We need to give the rationale. Rationale is who are the users, what are the benchmarks, or maybe who are the users, why I have chosen those users, which benchmarks, why those benchmarks, what is the percentage, why that particular percentage, and why performance materiality at 50% or 75%, and finally up to the revision till the audit progresses up to the conclusion. That was all from my side and happy to address any questions which are there.
Yeah, thank you, Vishalji, for an excellent presentation on materiality. So there are a couple of questions, with your permission.
Yes, sir.
So the first question is how materiality should be considered in absolute terms and or in relative terms, means either or both.
So absolute, I think so. The materiality, as I said, if you have to identify the materiality, it would be absolute materiality, which will be a number which will be derived on a, say for example, 5% of profit. It's going to be my absolute materiality. Okay, so that is my starting point, which has to be there, or 1% of my revenue, or 1% of my expenses, etc. I think so. Those are my absolute materiality, which has to be there. Which is my starting point. So your starting point has to be an absolute materiality only, and also your performance materiality, as I said, would be say 50% or 75%, depending upon the circumstances, which give you a starting point to to start your audit. So what it would mean that any error which is unadjusted in totality, which if it goes beyond 5 crore impacting one single account, maybe multiple items which are impacting revenue. In totality, it goes beyond 5 crore impacting revenue. I would say that it's a opinion impacting item.
Right. So do we need to create any documents in audit file where we combine all uncorrected misstatements and then show it that it is below the performance materiality or any such thing?
So I think so. It's an excellent question, Vishalji. Let me take a step back. We are living in an era of where we are giving an ICFR opinion on every financial statement, larger financial statement, I would say. Okay, not only the uncorrected misstatements, but also the corrected misstatements should be collated and addressed. And I'll come to the uncorrected misstatements. Even the corrected misstatements should be collated and addressed. Both to challenge the designed audit procedures and to challenge our evaluation of the test of controls which have done while opining on the ICFR. Okay. As far as the uncorrected misstatements are concerned, the uncorrected misstatements have to be accumulated, and the ideal situation would be, if I correct that misstatement, what would be the accounting entry I would be posting? To what extent it would be impacting my profit, my revenue, my total assets, my total liabilities, and my reserve, and what would be the post-tax impact of that? That is what need to be documented, because that would be the basis on which, as an auditor, we will make an opinion that when we are aggregating all the uncorrected misstatements, my overall profit still remains the same. Okay, so I may decide not to qualify, but I will definitely go and talk to those charged with governance about the list of the misstatements which I have identified, and take their concurrence on each and every misstatement as a part of my communication with them, as when I conclude my audit.
Right. Fine. So I don't think there are any further questions, sir. So on behalf of the AASB and the ICI, I thank you, Vishalji, for an excellent presentation on materiality. And I think the members have benefited a lot. And I very strongly believe, and I urge them that they should start documenting materiality, and I would say conducting audits, also keeping the materiality in mind. Friends, I would share my experience over here that once we follow the principles of materiality, we bring in a lot of audit efficiency also, not just the audit quality, but also a lot of audit efficiency, because then we have reasonably sufficient time to focus on the important areas, rather than without following materiality, we keep on doing the audits. I think with materiality, we are able to do a much more qualitative audit. And I think that is what Vishalji took us through in his presentation, that if you follow materiality, you not only bring audit quality, but a lot of audit efficiency also. Thanks, Vishalji, once again for sparing your time and sharing your knowledge with us on this platform. Thank you very much.
Thank you so much.
Thank you so much.
Thank you.
Thank you
And
so
thanks
much.
to all the
Thank you.
participants who have joined us in this webinar. Thank you and wish you a great evening ahead. Thank you, everyone.
Thank you so much. Thank you.
Thank you so much.